Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview of the market's key events. That means it's every other week. We look at key events and trading opportunities, whilst I'll just let you have a read of the disclaimers, just give you some objectives of the webinar. We think markets are primarily driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals, medium-term stories, or short-term themes that increase or decrease in importance over time. This week, we'll look at what we think is the overriding theme at the moment. That's around the Fed pivot. We'll look at how that is boosting US stocks, boosting risk sentiment essentially, and also then hurting the dollar. We'll briefly look as well at the 10-year US Treasury yield, just to show you what is happening there, which is primarily the driver then in seeing this boost in stocks and risk assets. After that, we will preview the main central bank meetings of the week, the main risk events. That is the Bank of Canada meeting today, the ECB meeting tomorrow, and then the BoJ meeting early Friday morning UK time, that is. And we'll look at the associated majors with those meetings. And then hopefully, if we have time, we'll briefly look at sterling, GBP as well, considering everything that's been going on in sterling, in GBP over the last few weeks. Certainly it's been an interesting time in markets, and just bear with me 1 second. Well, I'll just pull up the 10-year US Treasury chart actually, but this week, yeah, we've definitely seen really positive sentiment on the back of this Fed pivot term. This theme, if you like, which has even been trending on Twitter actually. We've seen a big rally in risk assets, which has pushed the dollar sharply lower this week. For sure, positioning has certainly been a big factor in the swift fall from the top in the dollar. The market was severely overcrowded in long dollar positions a few weeks ago, certainly, and that has caused risk assets, stock markets to bounce quite strongly, up over 10%, the US indices now from their lows, and we'll look at those shortly. But we think it's all around this Fed pivot theme. That's the idea that the Fed, the FOMC, will soon stop hiking rates and then soon afterwards potentially start cutting them. It was really, this idea was really probably kick-started again late last week by a Wall Street Journal article by Nick Timiraos, who is widely considered to have pretty solid access to Fed sources. The FOMC meeting obviously is next week, and we've been in a blackout period for FOMC speakers. So this article has gained quite a lot of attention. As I said, written late last week, and in the piece really actually on Saturday it was released, affirming the market idea that the Fed may begin to downshift from 75 basis point hikes that we've seen perhaps already after the November meeting. So we do get one then in November next week, a fourth consecutive 75 basis point hike, but then eventually there's a pause in this tightening regime at some point early next year, and that is meant to offer some time to assess the impact of the rapid pace of these rate hikes that we've seen. If you remember, Fed funds rate has gone from 0 to 0.25% as late as March of this year to a projected 4.25–4.5% after the December meeting. Interestingly, Timiraos, he also notes, the Wall Street Journal article also notes the variety of opinions among Fed officials. I think maybe that headline or that piece, that writing in the piece slightly ignored and markets really grabbing onto the idea of the Fed pivot. But certainly Timorese notes the variety of opinions, as I said, among Fed officials, some of whom are in favor of carrying on with the current pace of tightening and not wanting to signal any change in resolve as long as inflation persists anywhere near current levels. But coming back to today, yesterday, certainly this week, we've seen this sort of potent dollar negative combination. Treasury yields, that's US government bonds, their borrowing costs, essentially Treasury yields pushing sharply lower, really, and so then strong, and that boosting strong risk sentiment. And it's interesting actually to note the dollar weakness continued into late trading yesterday, and also we've seen it this morning, even after quite important mega cap big tech companies in the US reported weak earnings, and risk sentiment reversed quite sharply in some of the futures, especially in the stock futures. US futures, the NASDAQ is down, was down nearly 2% or so, but it does suggest this idea that Treasury yields are the primary driver of markets at the moment due to this Fed pivot. And you can see this chart here is just the 10-year yield on the US Treasuries, not something we probably look at a lot, but important as a driver for the dollar. It has obviously been ramping up to 4.33% actually late last week. That top then sort of failing around those levels, and we've seen the market yields push lower, so bonds prices, that is, push higher, yields go lower, and we're now back to nearly just above anyway the 4% mark or so. That's a key psychological level. You can see there we put it in that high, and we sort of oscillated around that level before breaking higher mid-October, but then we haven't been able to sustain that push above sort of 4.25% or so, and we're back now potentially 4% offers support, but a key level for US 10-year Treasury yields. And as I say, it's just quite interesting to check this chart every now and then as a driver for the dollar, especially. And aside from these yields, of course, yesterday we also got softer US data. That was in the form of weaker than expected consumer confidence and US house price data as well. And it's interesting really that the housing data, that's been getting more attention as a surge, as we've seen this surge in mortgage rates really from sort of below 2% only 12-18 months ago up to above 6% for 30-year mortgage rates now, and that is dragging the housing market lower, and potentially then further out in time this may contribute to higher unemployment rates, and then that further adds to the idea that the Fed will slow its tightening pace. Should point out, of course, that volatility does remain still fairly high. If we look at the VIX, this is the volatility index, Wall Street's fear gauge, generally known as options prices basically on S&P 500 out for 30 days. And you can see that's still really obviously off the highs around 34, but still sort of hovering just below 30, still elevated. If you think the long-term average, if we go out here, you can see the long-term average is around 20 or so. So 30 is still elevated. That means volatility still remains relatively high. There's also a similar bond index actually called the MOVE. That's just below 150. So again, uncertainty still generally quite elevated. And really, if you think about the last few weeks, we've seen obviously massive monetary tightening, crisis management QE. We obviously got the ongoing war in the Ukraine, the energy crisis, even though gas prices are obviously falling, and then just general recession risk. So those themes sort of still bubbling under, but at the moment, the Fed pivot theme is kind of driving markets risk sentiment being positive. If we now look at some of the technicals, S&P 500, you can see on the weekly chart, This candle here is really significant. That was the low printing at 3491 in the SP 500. That was just after the US CPI data, and then we obviously bounced there. We bounced, well, we fell through the 200-week moving average. That's that black line there, which is now at 3612. It was lower, obviously, when we were down, printing these lows below 3505. That's a fib level, the midway point of the pandemic low and the all-time high. You can see there. As I said, the low was 34.91. So through that 35.05, but it held as support, and then we bounced strongly, as you can see, the last couple of weeks especially, but above then the 200-week moving average, and also the mid-June low that we've been highlighting for some time, 36.36, again acting as strong support. So you've got strong support there on a couple of levels. We've moved now back above another fib level, the 38.15, actually 38.2 level. Now we're above that this week, and we're looking at now this 100-day moving average, which is that grey line, 100-week, sorry, moving average, that grey line at 38.97. If we just look on the daily now, you can see, yeah, that low, the big, massive bear, bullish engulfing candle there. Really interesting print there. That's basically a new low, but then a higher close, and you can see then we've pushed then above that 36.36 level, and then some near-term fib levels. These are fib levels from this August to October down move, and you can see we've broken above 38.2 bounce there, 38.10, and then we're pushing up towards the light blue line. That's the 50-day moving average, 38.68. We're pushing above there, towards there, sorry, so that's first resistance, and then the halfway point of this August-October downtrend is at 39.08, so that's a target for the bulls, but certainly some strong bullish momentum that we're seeing. And also we should highlight and we should remember that after the sort of September volatility we generally get, then seasonals are known to kick in, and we do get this year-end rally, a rally into December, even the Santa rally as well. So seasonals, a lot of people highlighting those as being a factor in this potential move higher, which we've seen, and it is actually the S&P 500 now just over 10% from these lows at 34.91. For as regards other US indices, should probably highlight some of those. We have the NASDAQ, similar type of chart, massive bullish engulfing candle, so a new low and then a higher close, and we've pushed above that mid-June low, which is 11.037, and also then out of this bearish descending channel, you can see that we've drawn here from the sort of, again, from near-term bearish channel, really from the August highs, and we're pushing out of that and up to the next fib levels, 11.693. We can see there's the next fib level, and then the 50-day moving average 11.879, the target for the bulls. The halfway point of this August to October fall is around just above 12,000, so sort of key levels just around there for the bulls in the NASDAQ, although you can see actually the futures were down 1.7% really after these disappointing releases from Alphabet and from Microsoft, so potentially a tough day in tech stocks especially, but we do get Meta after the close today, and then also Apple and Amazon after the close tomorrow. So key earning results, third quarter earnings to look out for, and potential direction for the NASDAQ especially, and then the wider S&P 500. Just looking at the Dow, we should highlight that's had a bigger push, if you like, through that halfway point of the August October fall. That was at 31,471. We're also above the 50-day moving average and potentially now heading towards the 200-day moving average. That is the black line there at 32,703 as a target for the Dow. Support then at the halfway point 31,471, and then the 50-day moving average should offer some support at just above 31,000 there, 31,038. As for the dollar, you can see certainly this fall over the last couple of days sort of top out really above 114, and that now really representing quite big resistance, if you like. And then we've fallen from there sharply a couple of days, especially down towards 110, a key psychological level. You can see we kind of fell through there, 109.93 the low today. This is in the DXY, but 110 a key psychological level, and that is probably tallying with the parity level in Eurodollar. If you remember, DXY, widely followed index, that's the value of the dollar versus a basket of 6 currencies, and the euro has by far the biggest weighting, around 57.6%, I think, from memory. Then the yen around 13.6%, and then sterling, GBP around 11.9%, the weightings, but euro certainly the biggest weighting in the DXY. So 110 probably tallies with around parity in Eurodollar, and you can see we've just sort of bounced off that level. Those were the lows actually in the October lows as well, 110.05, 110.09, I think. So we've just bounced off there today, but certainly dollar has been falling from the highs. Just checking out some data actually for this week. There are a couple of important numbers for the US, but probably none will likely change the market's forecast for the 75 basis point increase, the rate hike next week. We do have, firstly, we do have, let me just pull up the chart here. We do have US GDP actually, that's expected to grow after 2 negative quarters. You can see those charts there, the bars there below zero, so 2 negative quarters, and certainly third quarter GDP is likely to show positive growth after that technical recession we experienced in the first half of the year. Remember, a technical recession is 2 negative quarters of growth, but expectations really for growth of around 2.2%, I think the consensus is seeing. And that potentially, if we get a better number, of course, may potentially underpin some support for the dollar. But certainly consumer spending, that's under pressure, and residential investment as well may be a drag on growth going forward. Also on Friday then, another bit of US data actually this week to highlight. That's the Fed's favored measure of inflation, the core personal PCE deflator. That's expected to broadly match what happened in the core CPI. So consensus there is around an annual rate rise to 5.2% from 4.9%. With the economy growing and inflation heading in the wrong direction, then potentially, again, as I said, might underpin some support for the dollar. And this idea then of the Fed pivot may slightly change, but we'll see with these numbers on Thursday and Friday, the US GDP numbers, and then the Fed's favored measure of inflation, the core CPE deflator. Okay, let's look at some of the central meetings this week. Firstly, we get the Bank of Canada meeting. And really the key question, you've got a graphic here actually of generally what has been going on and some of the key numbers. But the key question is how much the Governing Council at the Bank of Canada will be debating whether it's time to scale back the pace of tightening, as a number of recent economic signposts really have been sort of more unnerving. We've had the latest business survey from the Bank of Canada itself that showed most companies expecting a recession. House prices are starting to decline, but then we also had a punchy, if you like, CPI number, 6.9%, slightly slowing from the prior 7%, but better than expectations. And also the core rose to 6%, accelerating from 5.5%. We've seen and heard enough of late, actually, from Bank of Canada officials, especially after that CPI data still being elevated. So markets really expect another oversized tightening move of 75 basis points. Interestingly, actually, analysts are kind of torn between a 50 and a 75 basis point move. But that in all, if we do get 75 basis points as the market thinks, would make 375 basis points of cumulative tightening. That's via 6 consecutive decisions of rate hikes. But a 75 basis point hike, that would take rates to 4%. Certainly then there's speculation around whether the Bank of Canada slows its pace of hiking. The market actually expects a 4.5% peak rate, as you can see here. So that means potentially a 50 basis point hike in December, and then possibly a final 25 basis point rise in early next year. But certainly Wednesday's hike, so it might not be the last. The Bank of Canada will probably be quite reticent to probably wave the all clear, if you like, and so forward guidance will be key from them, and they may well highlight those inflation figures, and then wanting to see CPI data under control. But 4% or so, that's pushing rates actually into restrictive territory, and this is where they wanted to go actually more quickly, but then after that it's less obvious that rates will need to move up much further. Wednesday's rate announcement will be followed by a press conference in which policymakers could then signal they are more data dependent, if you like, and that is key for markets, and markets will be looking out for guidance for messaging in fine-tuning rate hikes going forward, and potentially that could hurt the Canadian dollar. If we now look at the dollar CAD, actually, the chart for dollar CAD, which is obviously governed by oil prices, but the biggest driver actually for CAD at the moment has been the general global risk sentiment. Canadian dollar really highly correlated to stock markets at the moment, more so than actual crude prices, oil prices. So that is really something to bear in mind when trading the Canadian dollar, trading the loonie. It has performed or it is the best performing G10 currency against the dollar actually this year, even though it's down 7%, and obviously that's all to do with equity markets and really the bear market that we've seen in equities. Regarding dollar CAD, of course, technically then you can see, well, it's been volatile. We've had intraday swings, primarily again because of the equity market swings as well, but we are sort of pointing lower now. Last Thursday you can see that bearish engulfing candle here, so that means a new high and then a lower close, and you can see sort of just this edging down below sort of the 138 level, 137. The grey line there is the 21-day moving average, so that probably acts as resistance now above, and then we've just dropped now through recent lows through 136 today, and probably first support, initial support is around the October lows, just above 135, actually 135.03, 135.02, and you can see we dropped down to 135.11, but then have pushed a touch higher there. So off the lows for the dollar weakness, and dollar CAD as well has just bounced off sort of 135 level or so, which should offer strong support. Next up, well, you can see if we do break those lows, actually you've got the 50-day moving average, that light blue line at 134.02, just above there. So sort of big figures, sort of key levels now in dollar CAD ahead of the meeting today in a couple of hours actually. So 136, then 135 as key levels, and then sort of 137.06. Conveniently, big figures really being key levels in dollar CAD. Okay, next up is the ECB meeting, which we shall preview. If I just get up the next graphic, actually, or firstly, we can see ECB kind of playing catch up with other central banks, but playing catch up really. We're trying to stem rampant inflation just below 10%, 9.9% the last Eurozone CPI print, but you can see, yeah, playing catch up. We're kind of 1.25%, 1.25% in the Eurozone, and you can see just the other policy rates pushing much further ahead in all the other major economies, major G10 economies, at least for the time being. So ECB inflation, as I said, running into really near double digits. Then the ECB widely expected to roll out another big rate increase tomorrow. Markets have priced in a 3/4 point boost to rates. Really, this comes after a swathe of ECB officials put their weight behind such a move. And as I say, the bank is playing catch up in trying to contain this rampant inflation. 75 basis point hike, that would take the depo rate to 1.5%. That's the highest since January 2009. And really, since that's already baked into markets, then the market reaction, the key reaction, will come from President Lagarde's commentary in the press conference, and then any hints on further rate rises, with really markets looking for any tweaks to the meeting by meeting data dependent approach. And then also any references potentially to this neutral rate, which is deemed, I think, around 2% actually for that rate, and then potentially a terminal rate, so a peak rate, and any conversation, chatter around that by President Lagarde will be key for markets going forward. Markets, I think they see that peak rate around 3% by the middle of next year. And then there is also speculation that the bank may look at other levers it could pull to reduce price growth. And these include then QT, so that's quantitative tightening. That's about shrinking the balance sheet. And if you think that the ECB's balance sheet has ballooned to nearly 9 trillion euros over the past decade or so. So as well as hiking rates, they potentially will shrink this balance sheet, and that may affect the euro if we do have some chatter around that. A lot of analysts, economists think it's probably too early, certainly too early to enact any kind of measures to start this process, but certainly if there is sort of a lot of talk around that, and then even signposting some dates, say early next year, then the euro will get a boost from that talk. Certainly as well, in Europe, gas prices are grabbing the headlines. They've declined dramatically in recent weeks. I think they've halved in price, even though they're still very elevated, and this comes after the EU intervened in the power market essentially, but with prices falling, the energy crisis potentially calming down, then the fears around winter being a really deep crisis, they may potentially not come about, but certainly That said, a recession is still on the menu. We've seen IFO figures, German business survey figures being really depressed still, even though they didn't fall again massively. They're still depressed, still pointing to a recession in the Eurozone's biggest economy and for the wider economy as a whole. But there is hope, as I said, with these European gas prices not being, falling quite dramatically, and therefore hope for the euro. Whether that means there's a massive trend reversal in the single currency, really that depends on this confirmed pivot, if you like, from the Fed. That would then weaken the dollar further, but we won't really get any signals from that, of course, until next week's FOMC meeting. Just on the ECB meeting, finally, has consistently actually surprised on the hawkish side in the past few meetings, but that has had no real impact on the euro. And in fact, the euro within or after the next few hours after the meeting, really the euro dollar has actually weakened in the last 5 ECB meetings. So if we just look at the euro dollar. Let me just pull up this chart, which is here. You can see, okay, we've obviously had this big move higher. Interestingly, the euro had been knocking on the door of some potentially important technical points on the short to medium term charts, really, around the mid-July low at 99.52. That was here. And then before that, obviously, the September low we thought was a key level, really, or the early September low at 99.63. So we sort of oscillated around those levels, and then the last couple of days we pushed above that, pushed above the 50-day moving average at 98.90, and then this key level that we see 99.52, and we're now pushing above that. And certainly this long-term bearish channel that you can see here from sort of the February high, you can see we're kind of breaking out of there. I should probably extend this trend line as well, so you can see us just pushing above there and pushing above parity as well. Obviously parity getting a lot of headlines. Key for us will be a close really above these October highs, around parity, just below, and potentially then bulls looking up to the mid-September highs around 101.87 or so, if we do get this confirmed breakout of that trend line resistance of the long-term bear channel. Critical levels, really, really interesting as we head into, obviously, the ECB meeting tomorrow. The next meeting, the final meeting this week, is actually the Bank of Japan meeting, and certainly a lot been going on, obviously, with dollar yen that you can see here. This chart here, obviously a lot going on, as I said, but as regards the Bank of Japan, they're widely expected to maintain their policy settings. The central bank likely to keep rates at negative 0.1% and still stick to yield curve control. That means they target 10-year JGBs, Japanese government bonds, at around 0.25%. The central bank will also release its latest outlook reports containing board members' median forecasts for real GDP and core CPI, which the Japanese press actually noted will include an increase in the current year's CPI forecast to the high end of 2% from the prior 2.3% view. But certainly rhetoric from the Bank of Japan firmly suggests an unwillingness to tighten policy, as Governor Kuroda has stated that the pace of Japan's economic recovery is still slow, so the Bank of Japan must continue supporting the economy. and that raising rates now is inappropriate in light of economic and price conditions. Thinking about the central bank's decision actually to extend its pandemic relief program at the last meeting, that also attests to the Bank of Japan's lack of appetite really for any kind of normalization. Even though we've got the latest inflation print actually at 3%, so that's the highest since 2014 and way above the 2% target actually, but this has been driven by rises in energy costs. Regarding the yen, certainly the rapid depreciation is unlikely to spur as well an adjustment to monetary policy, with the central bank seemingly comfortable to leave FX intervention to the government. Remember, the Bank of Japan does not do look at the currency insofar as the intervention process. That's down to the Ministry of Finance and the government, and the Bank of Japan has actually even upped the amounts of its bond purchases and conducted unscheduled operations to defend the yield cap quite recently. And that kind of is further evidence, you have to say, of its unwavering dovish stance. Regarding dollar yen then, you can see the breakout from the previous intervention level at 145.90 actually, and then this sort of grind higher, and then the push, dramatic push above that previous long-term high at 147.67. That was this trend line here, and then this sort of very slow grind higher, and then really a spike higher before intervention. 151.94 was that high, and then a couple of days of strong, it appears, intervention by the Ministry of Finance, by the Japanese authorities, and some very wild, choppy days. You can see 151.94, and then the low 146.16 actually, so 500 points or so of intraday moves, and then also the next day where we dropped to 145.48 from a high of 149.71 even, so 330 points or so of intraday volatility. Yeah, we've highlighted 147.67. That was the previous long-term high, the spike high from 02, I think. And we're just trading now, interestingly, below there. That light grey line is the 21-day moving average, potential as offering support at 146.72. And then below there, you've probably got these lows, the spike lows really from the last couple of days, 146.16. And then 145.48 potentially offering support. Before then, we get probably back to the 145.90 or so, potentially as well as offering support, but that's in dollar yen. Okay, probably got time briefly to look at sterling. A lot going on in sterling, of course. Markets generally have been quite reassured in the last few days, potentially that we get more serious, thoughtful leadership is finally coming back to the UK, if you like, and also the credibility gap. The gap that opened up under the previous Prime Minister Truss, really potentially that's getting closed. The new cabinet in the UK, that looks quite familiar, and Jeremy Hunt certainly staying as Chancellor, that has also reassured markets further. And generally UK assets, they're returning actually to the levels before this fiscal event that we saw at the, in September, and the UK's sovereign credit default swap, that has recovered too as well to levels before that fiscal event. How much further can sterling rally is probably the key question now. That depends for sure on the global reassessment of risk, i.e. positive sentiment really, and if that then hurts the dollar some more, then certainly cable sterling against the dollar can go higher, but you have to wonder about this if we get any more or an extended further re-rating of the UK prospects, growth prospects, and certainly the focus is now on next Monday's, the 31st of October, the medium-term fiscal plan, potentially rumours of a delay in that by the new Prime Minister Sunak, but certainly that medium-term fiscal plan is key for sterling and key for UK assets. In the meantime, technically, you can see we're sort of bumping up. It's kind of negligible really where we put that sort of long-term bear trend, but channel, if you like, but we're sort of bumping up against the top of it as far as we can see. The top really probably tallying with the mid-September high at 117.38 actually. So sorry, that's probably a bit higher than the top of the channel, which we're bumping up against now, sort of around 116. The high today 116.19, and then we've pulled back below that top of that channel, but certainly support, strong support should be seen probably around 114.09. That is the pandemic spike lows that you can see there on the weekly chart, and also that tallies with the light blue line, the 50-day moving average at 113.88. So some serious support there of this break higher, potentially holding sterling dollar cable around sort of the 114 level, and then a push, as we say, potentially to 117 if we can hold above here. Okay, we have covered quite a lot, we think. For today's webinar, hopefully you've enjoyed that. We've looked at obviously the Fed's dovish pivot potentially, that giving a boost to risk assets and hurting the dollar, obviously previewing the three major central bank meetings this week, and also sterling. Certainly next week as well, we get a packed week with the Fed and with the BOE meetings as well, then with US CPI the following week. We'll speak to you in a couple of weeks' time. Stay safe out there and good luck with all your trading.